All right, let's get into CBDCs. Mr. Bill Campbell, before we get into it, could you just do a quick intro for us?
Sure. Well, hi, everyone. Thank you for attending and listening. I'm Bill Campbell. I'm a portfolio manager at DoubleLine Capital. DoubleLine is a multi-billion-dollar fixed income firm. We manage, we do have equities as well. So we're a multi-asset, multi-billion, multi-asset firm. We manage across, pretty much all traditional securities. My role is and my focus at DoubleLine is currencies and global interest rates. So I have an international focus. I have a macro focus. I tend to look mostly at countries from a macroeconomic standpoint. From a growth and inflation perspective. I look at the central bank policies and fiscal policies very closely. And I have a team that helps me look across the globe, and we also analyze trade and investment flows to help inform the decisions we make across currencies and interest rates globally.
Awesome, thanks, Bill. All right, now let's get right into CBDCs. I think before we get into central bank digital currencies, it's really important to kind of set the macro landscape. And there are a couple of big trends that we talked about prior to this webinar. One, kind of governments and central banks in this global race to debase their currencies. And then two, you've got other countries, namely China, that's kind of challenging US dollar global hegemony. So why don't we get into, just talk to us a little bit about how you see the monetary system today and how you see that changing over the course of the next 10 or 20 years.
Yeah, no, I think that's a good way to frame it. I think when we are thinking about this new digital finance revolution that we're seeing, it's coming at a very interesting historic time. It's coming at a time when we're seeing traditional policies, whether they're central bank policies, or fiscal policies, kind of reaching the end of the policy, the effective rope, is probably a good way to put it. For example, for central banks, we've seen interest rates lowered to historic lows, and through what we thought were lower bounds of zero into negative interest rates. And now the new talk is quantitative easing. Obviously, these policies have been in place for well over a decade, and central banks in developed markets own a large stock of countries' sovereign debt outstanding, and there's no end in sight to these policies. I wrote a paper a couple of years ago talking about the current quantitative easing policy is pretty much the Hotel California of monetary policy, that once it was started, they'll never be able to get out of it, because the temptation to continue to use more is always there. And even when we had economic conditions picking up, the central banks hesitated to unwind policies in any meaningful way. But as they tried to unwind policies, we all of a sudden started to see a lot of things in the financial system break. Whether it was the repo market, which if you want to go to doubleline.com, I wrote a paper about how that unfolded. I actually wrote it before. What we saw was it was just a byproduct of the, at the time, quantitative tightening, of the trying to remove this extraordinary policy that was put into place. So DeFi comes out, and this whole decentralized revolution is coming out at a very interesting time, because there are a lot of problems that these policies that central banks have that central banks are creating. There's a lot of concern about debasement. There's concern that people are not being included in a lot of the liquidity that's being provided. And DeFi is like trying to help address some of those problems. They're also providing a new platform for settlements, credit creation, security creation, and all of this stuff that's kind of happening in this DeFi world is outside of that traditional system, which I think is like the appeal. And I think that central banks are a little bit, and governments are a little bit behind the curve here in being able to roll out their digital platforms, I guess, in the central bank digital currency space. They're looking at it, but you saw ECB President Christine Lagarde say, well, we'll probably do it in about 4 years, is probably a reasonable time frame. I know the Fed is looking at July for putting out a prototype for what a central bank digital currency for the dollar will look like. I think that's going to be fascinating. But really, who's been leading the charge has been China, and I think China, because their system is command and control, and when we look at the growth model in China, it really is credit focused. And what a lot of DeFi, in my opinion, is it's creating new forms of credit and new forms of securitization. And they realize that, hey, this is a threat to us, because if we have a parallel system developed inside our country that we don't have control over, that's going to be a problem. So they've come out with now their retail central bank digital currency. It's a kind of a new solution for retail M1 or retail money. It's programmable, but it's centralized, and it allows them to have a lot of visibility and control. And it also came hand in hand with a lot of regulation. And we saw President Xi say, look, we need to address a lot of the issues that have come up around stability and economic stability from these platform companies and what they're doing. But we've given you the alternative of using kind of our government issued central bank digital currency, centralized digital. So they have their centralized blockchain, where now they're hoping that all of the benefits that are coming from the new digital revolution will develop on that. So there's a lot. I kind of put a lot out there. I'm happy to dive into.
We're going to unpack all that, Bill. We're going to get into all that. Let's set the stage a little bit. What exactly, let's start super basic here, but what is a central bank digital currency, and why are governments and central banks all of a sudden so interested in them?
So, well, a central bank digital currency is, just like a normal currency in digital format, right? So, it's supposed to be a store of value. It's going to be legal tender, which is huge, actually. The central bank, I think, when we look at the central bank, when we look at the central bank, digital currencies when they do come out, one of the key features, in my opinion, is going to be the fact that they are legal tender. They must be accepted for transactions in that country, whereas a lot of the other alternatives can be accepted, but they also might not be accepted. But it's a form of digital money, so I guess it's to provide the new platform for transactions that are taking place within a country, and settlement of those transactions, in the currency that's issued by the country. Now, I think there's kind of an interesting discussion here that there's been, when we look at what's happening on the more of the private side in this decentralized finance, solutions have already come up for the fact that CBDCs are not available by central banks already. So that would come in the form of stable coins, and we're seeing stable coins are basically a token that's backed by either treasuries or the actual currency from particular from different countries. And in my opinion, I think that it's an interesting bridge. Like the stablecoin is an interesting solution for people who maybe are concerned about the ability of new digital currencies to store their value. It gives them that alternative. But when you think about the stable coin, it automatically it carries with it an extra element of credit risk that needs to be evaluated. And it's the collateral. You need to trust that the company that is actually creating the stable coin, whether it's Circle, Tether, whoever, they have fully collateralized and appropriately collateralized that stable coin. So in essence, the stable coin is gaining its value from the underlying collateral, which is based on treasuries or currency of a country, which is based on the ability of the country to tax and the seigniorage or the ability to create currency from that country. So when CBDCs become available, isn't there going to be like a preference then for removing that source of collateral credit risk? Like, will the CBDC become the preferred stable coin in any environment?
Yeah.
I kind of think that my guess is that yes, it would. So I think the stable coins right now seem very interesting. They're presenting a lot of use cases. We're seeing the private sector, especially Visa, coming out and the ability to settle transactions on decentralized or on blockchain in stable coins. I think is huge advance, and is going to provide an interesting avenue potentially for CBDCs to come out and not be their own centralized platform exclusively. But that's an open question. I think we're gonna have to think about what is the regulation that's going to accompany a rollout of a CBDC. But even still, I think that again, the credit risk that's kind of embedded in a stable coin right now is is going to have to be somehow I think there's going to need to be another value proposition for them to kind of stay competitive when central bank digital currencies come out.
Yeah. So let's talk, when you're looking at something like a central bank digital currency, when you look at money today, most money is already digital, right? Even if you look in the US, where we're sort of behind the 8 ball on this sort of thing, I think it's something like 96% of currency moves in some kind
like
of digital
95,
format, right? Yeah, it's some huge amount. China, I think it's even much more than that. So what really is the difference then? When people talk about, oh, it's going to be some new digital currency, right? What's the structural change that we're talking about as CBDC to what we have now?
Well, okay. So first of all, like that's a fantastic question, because when you look at the majority of transactions that are taking place in our system today, it's not all done in the actual currency. Like I think that looking at credit card payments and looking at a lot of short-term credit that's provided, essentially, we're seeing like these electronic payments being made, via liability of Visa or MasterCard.
Yeah.
So when the central bank comes out with the CBDC, you can now settle all the transactions in the liability of the U.S. government, for example, or the European Union or the particular sovereigns there. But I think that that's an important distinction to understand, because as if you're a retailer who's accepting those transactions, you really are kind of accepting now I'm not saying Visa and MasterCard are going to go bankrupt, but you are accepting their liability. And is there going to be a preference then from the retailer side that said I'd actually prefer the CBDC, and it may have lower transaction fees, it may there may be less involved. So from that side, there, when a CBDC is, delivered, you may see some disruption, in the normal credit system. Also, from our perspective, when we're settling any everyday purchases, would we have a preference for CBDC? Because if we use a credit card, you get busy, we're traveling, you forget to make the monthly payment on time, you get dinged with a small interest rate charge. But CBDC is effectively like a debit card against where you're actually like using the central bank where you have the U.S. government's liability against it, so you can settle the transaction immediately with no inherent credit within that transaction. So would there be a preference then for people who are fairly worthy credit borrowers to just say, what, I don't even want to kind of mess with the old infrastructure. I prefer to settle, in kind of this new method and avoid those charges. There's going to be knock-on implications from that, though. Think about the cost of credit that then, if the only people who are now using those, traditional credit channels, are people who actually need the borrowing capacity.
Mm,
Well, if that's not being subsidized a little bit by people who can, pay the amount off in big amounts, large amounts off quickly, does that then adversely impact the lower income? Because now they're the only people who are kind of still needing to access that versus, the preference for, the CBDC.
right.
Did that
And
answer your question, or
it
did
did.
you
Yeah, it
want to
absolutely did. I think
elaborate?
just to sum up what you said there, you're basically shifting the counterparty, right? Of, most of the money that's in the system is not actually money, it's credit, right? And they're big
Yeah.
issues. Most of the credit that is issued today actually comes from the commercial banking system. And what we're talking about is shifting all of that to the central banking system. And I think that's really interesting because connecting that back with how we started this conversation, one of the big trends that's going on right now is currency debasement. I guess what I struggle to see is what are CBDCs really solving for then? Because we look at the world today and there's something like $15 trillion or something in negative interest rates. And to me, what I see there is the central banking system is essentially punishing the commercial banking system for not creating enough money, right? They're saying, don't hold on to your money. You got to lend that stuff out. Otherwise, we're going to penalize you. And what it seems like CBDCs are that final tool that they've needed in their toolbox to just say, you know what, you guys aren't doing your job. You're not creating money. We're going to take on the job of creating money now. And I feel like that there are a lot of problems with that. What do you think about that whole framework?
Yeah, no, I think I think there's several points in there that I'd like to tease out. I
Yeah.
think it's very profound. To answer your initial question, what are CBDs solving? I think the CBDCs are literally just a catch up to the DeFi revolution that's happening. So it's the central bank's way, as we talked about. There's a new ecosystem, a financial ecosystem that's developing that is outside of the traditional ecosystem that exists. And the biggest problem there is in the traditional ecosystem, central banks have control of the money supply. Central banks have control of short-term interest rates, and to a certain extent, central banks can influence, credit. There are some problems like you just discussed that I'll get to. All of that does not exist in this new, world. So first of all, there needs to be a bridge for, central banks from their perspective, to try to deal with, all that's being implemented. And quite frankly, the pace and ingenuity that has happened in the DeFi side has been astounding. So I think central banks are a little behind the curve, but that I think is what they're solving for. Now, like we talked about, central banks have kind of reached a limit on what effectively they can do. Yes, they can do some more quantitative easing, but right now we're discussing policies such as universal basic income and modern monetary theory, whereby we're saying that the money that the wholesale, let's call it the wholesale central bank digital currencies that exist in the traditional banking system are not getting lent out and they're not creating growth and inflation in the way that central banks would want. So now there are all these theories that are saying, well, maybe if we just give money directly to people, that will actually spur growth. And I have a thought on that in a second. But what the CBDC is now, like this new framework, is it's allowing the rails to make that happen. So the ability for central banks to now and bypass the banking system and be able to put digital currency in your account, my account, whether it's at the central bank or at the Bank of America or whatever bank you choose to use, is very powerful. Now, if they have the ability then to attach a negative interest rate on it, or to try to spur its use, I think that it's very likely that you could see it. And then there's a whole problem of anonymity. Like they could probably see it, depending on how these things are, the anonymity that's provided, which I don't think there'll be much, but if any. But so if we assume there's no anonymity, then they can compare against your tax return and say, if you're a lower income tax bracket, I know you're going to spend this, so I'm not going to charge you an negative interest rate. If you're higher income tax bracket, maybe we'll start targeting higher income tax accounts to try to get that money flowing instead of having it sit where it is. Now, I think that, that's again just something to think about. Is that a monetary policy or is that a fiscal policy? And is there going to be new legislation that needs to come into play to address it? I would argue that quantitative easing is a quasi-fiscal policy, and it's questionable as to, how much leeway central banks, really should have in how they're monetizing fiscal deficits. So it's going to be interesting to see as the CBDC is rolled out, what legislation, not only on the private side, as far as regulation comes out, but also on the CBDC itself and these new rails that are put in, what type of, new rules of the road are put in, if any, on that. And then just one more point on the, on the negative interest rate versus universal basic income.
Right.
There's a theory, like if you think about universal basic income, the idea is you give money to individuals, they should spend it, and they'll spend it more. Now, there's a theory that, like, what's the difference between, giving a universal basic income check or a one-time income check to an individual, or cutting their tax rate so that effectively they keep, the same amount. So net, if we assume that everyone's rational, there should be no difference if those two amounts are exactly the same. I would posit to you that they are extremely different in the psychological aspect of it. If you are given a tax cut, that's money you've earned, and you're probably going to be a little bit more thoughtful about how what you do with that money that you're allowed to keep that you already earned. When you're given universal basic income, even if you paid tax and you get, the stimulus check or the universal basic income check back, that feels like free money that you're given. And I think just look at what happened in the pandemic with the, we saw the explosion of, all the online trading accounts and people, like, good for them. Like they, you can argue that that was a form of savings. But I feel like that money that's given by universal basic income, the psychological aspect to spend it or use it in maybe, more, a less, safe way, will have a lot of appeal to governments and how they're thinking about, you kind of had a little bit of a petri dish experiment, from what we saw during the pandemic. And we did see, a lot of, interesting uses of, what that UBI check was versus when you get a tax cut, what, how that money is used.
Yeah. So just to sum up kind of everything that we're talking about in the last 15 minutes here, it almost seems like we're kind of moving from, monetary policy one in the form of QE to a more fiscally dominated policy, right? In the form of kind of infrastructure spending and direct government spending. And one of the things that this reminds me of, this last step, right, to the liabilities of central banks being legal tender, is it reminds me of, I don't know if you know Lacey Hunt, but that's his thing, right? He says, and they're all, it's very popular right now in macro land to say, hey, I'm an inflationist, I think this has changed. And Lacey Hunt's out there who's been right for like 20 years. And he's just said, look, the Rubicon to cross before we get inflation is when the liabilities of central banks become legal tender. Are CBDCs going to help us take that next and final step and lead to secular inflation?
I think it depends on, like, that's the, so I think in the universal basic income aspect, yes. And, because you're getting money out of the banking system into individual people's hands. Lacey Hunt's argument is absolutely right. And I think we could even see, his arguments start to work out, in the current framework, if we all of a sudden, just like all the treasuries that have been purchased, like they just, it just kind of is written off. That there needs to be an agreement between when although the Fed prints money, the treasury is effectively, creating money. Like they're the ones that, are figuring out, how to spend it, and either they have income that comes in, or, they're issuing a liability, they're, issuing a bond against it. So if all of a sudden we just allow the central bank to say, okay, now we're like without, without any revenue source against it, just go full hog, and that's when we get into the big debasement argument. I think inflation is going to come flying it will come flying back with a vengeance. Now the most interesting thing I think about, that like we're in this quasi, like we're almost there, kind of right now. And I think a lot of people have been surprised that, we haven't had more adverse outcomes, especially on like this debasement, the currency debasement side. And I think that like what's prevented the currency debasement is everyone's doing this at the same time. So when you have like, just uncontrolled spending in, say, an emerging market, what usually happens is savings fleets. Like people realize, okay, this is out of control. These, the currency isn't worth the paper it's printed on. So I'm going to come into US dollars. I'm going to go into euros. Well, the question is, where do you go now? Like, where does savings go? So in emerging markets, like a lot of times what emerging markets try to do then is they put up capital controls to try to prevent capital from leaving. So I've kind of just, just off the top of my head, I was, doing a little thought experiment that since every major economy around the world is engaging in, these extraordinary printing, quasi, printing policies, and the savings on the globe really has nowhere to go, are we effectively in just kind of like, one big capital control world? And then all of a sudden, that's where the DeFi comes in, and you can say, well, whoop, here's the escape valve, maybe. Like if you now, what I will say is you need to have institutional credibility around this, this escape valve. And maybe this is something that we can get into.
Yep.
Whereby, and I think this is where, the discussion about, well, what about China as well? Like if, we're saying that the US is, engaged in most, developed markets are engaging in all this spending and debasement. What's going to happen to the reserve currency status of the dollar? Is China going to take it over? What about, DeFi? The other element to that is institutional credibility.
Right.
And I think, this is really where, courts and protection of individual rights, trust that if there's a bankruptcy, that it will be, litigated in a fair and appropriate manner and the rules of the road, that, auditing standards are, clean, fair, and can be trusted. All of these are very important for where savings goes, right? So, if you're, if you're, exporting to China, and you've sold a bike in China, and now you have, some digital yuan. What is it, now you've switched from, where is the commercial interest for me to sell it, to now what is my, where are my savings preferences for this? Now China's a command and control economy. They have, put up a lot of, they've been very impressive about, the way that they've been able to control their economy. They still have, a lot of growth to go through as they bring more people from, the farmland into more urban settings. I think if you just look at, kind of how, GDP works, you have its population growth and, productivity growth, plus some capital deepening. But on the population growth, even though they, they're not, it's, they're at kind of the end of the population boom. The amount of people that are, still low income in their economy that can be moved up to middle is huge. And that's kind of like that urbanization rate, moving from the farms, to a city center, increasing the productivity. That, it can be interesting, but does that offset the, question of, do I trust, audited financial statements? Where can I put my money where I know if there is a bankruptcy, I can be treated just the same as a local person, and it'll all be, sorted out. Now, China's going through those growing pains right now. They're going through, a lot of defaults and restructurings, and they're building out that process and framework as we speak. But that as a, now from the savings preference side, you're going to say, well, maybe I do want to come back to, I want to convert that money back and bring it back either into euros or to dollars, or to Australian dollars, somewhere else.
Right. So, moving on to that second macro trend that we outlined at the beginning of this discussion, kind of other countries, especially China and Russia, really wanting to lead the way out of a monetary system that is based around the US dollar as a global reserve currency. How do you see this all shaking out? Because on the one hand, you see the US dollar as a reserve currency system isn't really working out for a lot of different constituents, not just other countries in the world, but even in the US domestically, there are a lot of problems with it, structural deficits, all that kind of stuff. On the other hand, you do see China is trying to move away, it seems like, pretty aggressively from the US dollar as kind of the global reserve currency. You see this in their One Belt, One Road initiative, all that kind of stuff. What do you think the future of that reserve currency really looks like? Because on the one hand, you just mentioned there is that lack of kind of institutional trust. Do you think that, how do you think this all sort of plays out?
Sure. So I actually, again, there's another paper on doubleline.com where I walk through, I think this moves to more of the international payment settlement systems. And I believe that maybe instead of crowning a new reserve currency, as a new currency as the reserve currency, we're going to move to much more of like a multimodal world that's going to reflect two things: the trade flows. So you're going to want to have, as a central bank in your currency reserves, the reserves of the countries that you do more trade with, especially as this DeFi revolution, and we start to see more blockchain technology used for international payment systems, which, by the way, China just did a joint venture with Swift, and they've been leading the way on, CBDC for M1. They could be leading the way, for the international settlements as well. But I do believe that eventually we're going to get into, a much more frictionless, there'll still be some frictions, but frictionless international payment settlement system. So for a lot of countries that, are going to say, hey, I want to retain sovereignty of my own currency. I have my own CBDC, and we have this, payment settlement system, whether it's private or it's central banks, talking to each other. That's going to basically make currency reserve, like countries look at their currency reserve basket and say, this should much more reflect the actual trade that's happening from my country. So instead of all trade being settled, or the majority of trade being settled in US dollars, we're already starting to see China and Russia say, no, for oil, let's go make deals with Middle Eastern countries. And, we're going to say, okay, we want yuan, we're going to try to settle this in yuan, and we're going to give you, swap lines to the PBOC, and start to, create more of an interlinked global payment structure. So from that perspective, I think you're going to see obviously a reduction in, US dollar holdings over time. It's not going to be tomorrow, but over time, the preference for, holding the majority of your reserves in US dollar will go down in favor of reflecting what your country's trade basket is. And then you're going to have to say, okay, but what do I think about the policies that are happening in the countries that I'm trading with? So, we discussed China, but let's discuss the US, where, there's deficit bill after deficit bill, for whatever, now we're talking about infrastructure, and now there's talk that, we're going to need another multi-trillion-dollar bill. So do you say, well, wait a minute, do I also need to, kind of hedge against some of this debasement risk? So I think that's where then you could get some preference for countries that aren't engaging in as bad policy, or gold, or, even like as Bitcoin becomes more institutionalized, I'm not sure how, if it can, I want to see, if it can really start to handle the institutional flow and institutional transaction volumes and flows and need for latency and all of that. Maybe it's Ethereum takes over, but maybe you get, or it's it's Cardano or somebody, can come out with, a global standard that is kind of accepted as, another scarcity asset that would protect against debasement. So that would be kind of my thought, is that the reserve currency status of the dollar will get diminished to more of a basket of currencies that's going to differ by countries, based on two things: one, trade flow, and second, savings preferences.
What do you think that transition looks like? Because the entire monetary system right now is built on a US dollar reserve currency. So what does that transition kind of look like,
It's
in your
happening.
opinion?
It's happening. It's happening. So the paper I wrote most recently, I'm looking
So
at
where do
the
you have the time to invest? You're writing all these papers, you're
yeah, well,
investing. DoubleLine's
that's
going to be
every
paying you
day.
more.
That's every day. We're we do a lot at DoubleLine. That's
Mm,
but these are important trends because you need to think about if people are dumping dollars, where are those dollars going? And what we're seeing is the regional economic partnership out of Asia. Then you're seeing also the ECB try to increase use of the euro, the international settlement of the euro. These trade policies that are kind of starting to try to remove the dollar as the central player of global trade and global finance have already started. And it's in its infancy, but I think you need to pay attention to these international agreements. So the RCEP is the one that we need to pay close attention to now. That's kind of the Asia Economic Pact and Trade Agreement that China is involved with. Is happening in Asia, and the idea there is it's not going to. I don't think it all happens in one big bang. I think it happens slowly over a course of time, and we're going to see more. I think you just have to watch the international trade agreements as they develop to kind of see who's going to be the leader and who's going to be the laggard. I do think that what this does present is, and this comes back to the investment thesis, that it creates a structural headwind to the dollar as it starts to take a step back as both percentage of global reserve holdings and its use in global trade. Maybe it can retain some of the savings preference, but we're going to have to see how that plays out.
yeah, absolutely. And last, I guess, question on this before we get into DeFi and some of the more technical aspects of CBDCs. At the Bretton Woods conference, when the decision was made to move to a reserve dollar system, there are a couple of institutions that also came out of that conference, right? Which was the IMF, the predecessor to the World Bank.
Yeah.
It strikes me, I'm having trouble thinking about how the governance would work, in a basket of different currencies. So do you think that we need to create, would the IMF be somehow in control of that? Do we need new institutions? What is the institutional framework for managing that bucket?
Well, the idea that we're going to go to the SDR basket that's going to be governed by the IMF, I still don't. I don't like that framework. I think so. The IMF is the IMF and World Bank are having their meetings this week, and I was struck by the amount. Like I understand that there's a need to continue to support economic growth. But there seems to be a feeling of complacency across all of at least kind of the initial world economic outlook that I listened to this morning about debt growth. The use of all of these policies that they said, look, there's more policy is needed to try to get us out of the pandemic, and we can counterbalance that with transparency on debt growth, and we'll just target it correctly. And then maybe like the idea that governments are going to be able to target individual groups to be able to help inequality, to be able to bring a more stable and inclusive growth forward. I tend to believe that free markets work a lot more efficiently. And I think that in the DeFi world, that's what that's kind of what we're seeing. And I don't think that when we get to go back to the central banks and we think about this global basket, like kind of each individual country's basket of reserves that they're going to hold, that they're going to want to give up any of any ideas of governance to somebody like the IMF. Yeah. Now, the IMF helps countries that hit crisis, have debt sustainability issues and need emergency lending. But is that like, do we need a global body to tell us exactly how we like all countries need to manage their baskets of currencies in their reserves? I'd say no. One interesting thing though is China is now, because they've led the CBDC rollout, they've pushed forward, and they're trying to push forward the global set of standards on, what CBDCs, like as far as, international settlements, that there's no harm to other central banks, that, they actually, I think, they listed a whole set of standards that they would suggest would be the protocols for how CBDCs, should be governed, maybe from a global perspective. But again, I think that it's much better if that comes from individual countries themselves on a bilateral basis. Maybe we can get into, bigger trade agreements, but that's going to be done, that needs to be on a country by country specific basis, in my opinion, because this idea that one size fits all always leads to problems and always leads to inefficiencies. And it just is something that I would advocate against, I think.
Yeah, absolutely. Let's get into DeFi a little bit. You've kind of hinted at this, talked about it a little bit before on this call. I think the way that I frame DeFi is that, if CBDCs become the standard, then you've moved a lot of the responsibility, the traditional money creation and lending responsibility that used to reside in the commercial banking system. The central bank has taken on a lot of that control. And I think what you're starting to see is these decentralized protocols kind of pop up and almost be protocol or software that is like a lending protocol that could directly line up with or complement a CBDC or something like that. So I guess the way I frame it is, I think DeFi is actually highly disruptive to the commercial banking system. Do you
Yeah.
agree, disagree?
Oh no, 100%. And it's when we're looking at DeFi, I think there's a few questions that come out. Like one, it's extremely disruptive both to the banking system, to securities markets, to just payment settlements, all of that. Now I know like Visa is like kind of taking the lead, it seems like, on trying to step up their involvement in the space, which is good, and they're clearly an evolving company, and I think that it's very impressive what they're doing. But I think that outside of that, when we look at all the new protocols that are popping up, the question is, I think each individual one needs to like kind of ask it. Well, the regulators are going to start to ask, what is this? Is this a new form of credit? Is this a security? And are all of the same rules that we've put on the traditional banking and securities side applying to these guys? And I think you're going to see a very slow. I think right now that regulators are lagging behind due to the lack of understanding of what's happening. And my concern is that you're going to have a use case that comes out that might be, somewhat harmful, that gets the regulators' attention, and then they come in with a sledgehammer. And I think this regulation is, I almost like, I know this may be a little bit, controversial to say, because there's so much innovation happening in the DeFi space, but it's almost like you want to get a little bit of the regulation, or some framework of what that regulation is ultimately going to look like in place now, so that like, okay, these are the rules of the road, and now we can like develop around it and really make this work and run with it. I think what you don't want is to end up in a situation where a whole ecosystem is developed, and there's a heavy-handed rule or regulation that comes across that just cuts it at the knees. So I think it's hugely, I have a lot of fascination and admiration for the development that's going on in this space. It's hugely, it's solving a lot of problems that, the traditional system hasn't been able to solve. And I think that that needs. I hope that is taken into account and respected. As we start to see kind of the lagging new regulation come into this space. Oh, sorry, are you on mute? I can't hear.
Oh, sorry about that. Yep. But we've got a lot of really great questions from the audience here. And I'm looking at one of them that I actually know we wanted to cover in this talk. So I want to transition into the audience question portion of this seminar. Do you think that private sector players may work with the US government to develop a CBDC? And if you could touch on what we were talking about in terms of kind of Silicon Valley digital banks, right? And kind of those private tech companies rolling out solutions.
Well, so this the Silicon Valley piece, maybe put to the side. I think that my focus actually, I was really impressed. Again, I brought up Visa a few times, but the ability of them to settle a stable coin on Ethereum. Ripple has come out with a paper where they're looking at helping cross-border their solutions potentially for cross-border settlement of CBDCs. These are all fantastic. And I think that, as long as they're, now this is where, we get into how much control and, through what type of control our government's going to want to have, in this new environment. So I really hope that these private solutions, bridge that gap between allowing CBDCs to integrate organically in the ecosystems that already exist. My concern is that the loss of the central bank policy tools that we talked about, ability to set interest rates, ability to control credit, ability to control the money supply, start to weigh into the regulatory, or the idea that maybe now we want to follow more of a China model and get it more centralized. I don't have the answer to to this question. My preference would be, given all of the fantastic evolution and ingenuity that's coming out, that CBDCs work as best they can to integrate into the private, the decentralized universe that is developing. And I mean, I think it's, it's to be watched. I think that absolutely, from what I've seen, that the private sector is creative enough to, provide the platforms to central banks to allow that integration. The real question is, will, governments and regulators, be comfortable with that as a solution versus creating a centralized network, which we're seeing more out of China.
Yeah. All right, next question here. I'm paraphrasing a little bit because this comes from a longer paragraph, but basically, do you think that how is the US government going to react to a transition away from the dollar as a reserve currency? Because right now it's a really important tool, right? We didn't really talk about sanctions, but sanctions are an important tool that the US government uses to kind of impose its will, right, on other countries and get foreign policy enacted. So are they just going to be okay with this transition away from a dollar, or what does that look like?
Well, I don't know what they can do. I mean, so to answer that question directly, they're going to be uncomfortable, and I think you're going to see political pressure. Especially they're trying to get the European Union to go along with a lot of the current policies that are put in place. I think you're going to see that type of international pressure try to be applied. But this gets back to what we were discussing about the long-term headwind to the dollar, because the other piece that we didn't focus on is when the U.S. has been able to basically lever up, buy a bunch of goods from the rest of the world, but then the rest of the world's savings sits, in a large stock of international savings sits in the U.S. The U.S. has one of the largest negative net international investment positions in the world, and what that means is the amount of external assets that we hold versus the amount of people who hold stocks and bonds and treasury bonds in the U.S. The balance is so far tilted to all sorts of savings sitting in the U.S. Uh, as that starts to leak out, when people say, look, one big reason for keeping a lot of the savings in the U.S. is the fact that a lot of trade is settled in dollars. And as that naturally goes down, which the U.S. will fight tooth and nail, I agree with the person who asked the question, that the U.S. is going to try to not let that happen, but it's already started. You're going to see then, people like start to pull money out, and that's going to continue to lead to, the structural, in my opinion, it's going to be a structural headwind, to the U.S. dollar. So, I think that again, near term, the dollar is going to have fluctuations based on risk preference, risk appetite, the relative growth of the U.S., relative investment returns of U.S. assets versus international assets. And those tend to be cyclical and fluctuate with different business cycles. But then there's a longer term trend, which I think is what we're discussing in this particular answer, which is going to continue to weaken. And the U.S. is either going to have to fix its current account deficit, or you're going to have the currency continue to weaken in order to fund, all of the issuance and credit that it needs.
Yeah, Bill. All right, we've got about time for one more question here. I'm really glad that someone asked this because I think this is one of the most important questions out there right now. What are your views on the implications of earning interest and loans on crypto assets? How does this disrupt money flows into bond markets, or does it? And I have an opinion
Oh,
on this. Yeah. What do you think about
Oh,
that?
I think it's no, that especially the short-term interest that you can earn, on like in the crypto space. I think you can pick up, what is it, 5 to 7, even higher interest rates just for short-term demand deposits, which are effectively short-term demand deposits. I think that it's hugely disruptive. Now the question is, can those return, like the differential in those returns, how long can they be sustained on the crypto side? But I think that when we start to think about the build out of the new kind of DeFi, or like the new digital finance world, I should call it. This is why I think why this side of the fence would say you would actually want to get regulation in quickly, because then you can bring more institutional more institutional solutions into this space, and then people become more comfortable that, okay, this is a space that actually has longevity, is providing interesting returns, but is also has a framework for regulation that we can get comfortable with, and that we can then sell our board and our investors on. I think that that would be net positive. And I do think that given the financial repression that we are seeing across the globe, and specifically in developed markets on the front end of the interest rate curves, this is just a natural, this kind of a natural byproduct of it, a natural response to it.
Yeah. I think one of the most interesting things about this is, one, it's kind of classical disruption, right? Because governments, with the amount that they're borrowing, they don't really have the option to raise interest rates, right? If theoretically capital were to start moving more and more into crypto to sort of capture these yields, there's not really much they can immediately do about that. And the other very interesting thing is, if you go back to when the US government made gold illegal back in the 30s, Executive Order 6102, the reason that they did that was because we were going through a depression. Gold, back then the dollar was pegged to gold, and They had to reserve at a certain, it's like 40% had to be backed. And because people were worried about the dollar, they were withdrawing their gold. That interfered with the government's ability to essentially devalue its currency and fund itself. So it made gold illegal. And the important thing to note there is that they banned gold because that threatened their ability to devalue their currency. It would be very interesting if the way that we devalue our currency right now or fund ourselves is through these treasury auctions, right? So it'd be very interesting if crypto or Bitcoin or the ability to earn yield interfered with the government's ability to fund itself through
Oh,
treasury.
yeah.
Like, that's it. That's how it becomes illegal, I
Well, and
think.
then then it becomes a question of, do governments want private entities creating currencies? So then you get into, I agree, like this is where you can get into a lot more heavy-handed regulation. And the other side is like, think about what it does to just bank deposits. If
Right.
the
Yeah.
more institutionalized or the more standardized and comfortable people become, with being able to earn a good short-term yield on a crypto asset in a safe way, like now you're really going to disrupt the banking industry. And is like, if bank deposits started fleeing the traditional banking sector, you started to get bank runs. Is the government going to be comfortable with that, or are they going to like what? How? I don't have the answer to what the response will be, but I do see that as a like that is a risk. And I think that you point out that, and the question too rightly points out, it's a huge disruptor to the
Hmm.
to the current system, as there's so many use cases that are huge disruptions and potentially in a very good way. But it needs to, again, I just think we need, it would be good if there was a more clear, comprehensive framework in place, so we wouldn't be constantly on pins and needles, in the new DeFi space of saying, okay, what is the new announcement going to be of the regulation, and how restrictive is it going to be?
Yeah. All right. Well, that's about all the time that we have, Bill. This has been a ton of fun. By the way, folks, if you're interested in this, especially this last 5 minutes, you should definitely tune in for our next webinar, which is going to be on April 15th. And we're going to be talking about Bitcoins versus bonds as a form of pristine collateral. So that actually lined up extremely well. Again, a big shout out and thank you to our sponsor, Fireblocks. Again, if you are any sort of practitioner in the space, holding, moving, securing any amount of assets, you should absolutely go talk to them. www.fireblocks.com. Bill, where can people read more about you, your wonderful papers, follow you, get more information, anything like
Right.
that?
So go to doubleline.com, and you can see papers not only by me, but by all of our analysts and portfolio managers. DoubleLine prides ourselves on trying to be thought leaders, and also we pride ourselves on continuing to work for our clients. So please check out all that we're doing at doubleline.com.
Awesome. All right, Bill, thanks so much. This has been fun. We'll do it again soon.
All right. Thanks, Mike.
All right, take care.